The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, we saw the Federal Reserve on Wednesday. They held steady on interest rates this month, but they indicated there could be another one later this year. Meantime, grains found a little bit of support, especially the row crops and Chicago wheat, while cattle and hogs had a pretty decent day as well on Wednesday. We got to try to unpack everything, though, that we are looking at right now. Here to help us do that, Mike Zuzolo, Global Commodity Analytics, is with us here today. Mike, always good to have a conversation with you, my friend. I hope you're having a good week so far.
Having a great week, Jesse. Just returned from Hannibal, Missouri, met up with a client in Indiana, and got a great crop tour from him for the Eastern and Central Corn Belt, and back out this way from Hannibal across the state of Missouri and into Kansas. So good week to visit and good week to take a drive and see the beautiful crops.
Yeah, and just get a look at things as this fall harvest starts to ramp up. I know that's a little bit of maybe what we're seeing in this overall trade right now. It's just some of that harvest type malaise, Mike. So I know that's one thing, but we'll talk about that in a second. I want to start with the Fed. That's the biggest headline, I think, on the day, Wednesday. Federal Reserve held steady on interest rates. That was pretty much as expected. Their tone was a little more hawkish, though. Were you surprised by that, Mike?
Yeah, I was surprised by their GDP numbers especially. And you're right, the September no move was expected. The market was dialed into that really well. Expectations for another move in 23, however, were not. And I think more aggressive moves in 24 were certainly not, in my opinion. We're talking about a top end of 5.75% on the federal fund rate on their numbers now after today's update. As you and I are talking, Chairman Powell, I should say, is giving his press conference, but GDP sticking at 2.1% this year and going up to 1.5% next year, I think really surprised the market, certainly surprised me. Market reaction initially is the dollar went from about 500 points lower to positive, and that was led by the bond yields going from essentially negative up to a brand new high. 2-year yields now, this is your 2-year bond yield chart. And, if you don't know much about the bonds, know that bonds and yields move in opposite directions. And so new lows in bonds mean new highs in the bond yields. So the 2-year maturity is now penetrated the 2007 high, where I've got the little time bomb there, or the little explosive device there. We have the 2006 level now at the place where the 2-year yield looks like it wants to stretch its legs to. And if that's the case, then we can continue to assume that the dollar is going to stay very, very strong. So do we get our wheat low here this month? It's going to be a lot harder after today's initial update and what they actually put out while you and I were talking.
Well, on top of the Fed, another thing that I think is permeating in this market a little bit that I know you wanted to mention and focus on today, and you highlighted it a little bit, is unleaded gas prices. And we take a look at, $91, $92 crude oil and high gas prices here, high diesel prices as we get into fall harvest. And this is an interesting thing that I think we need to pay attention to as well here, the impacts on the grain and livestock trade.
Yeah, we had China and we had Europe before the last couple weeks, the Fed would know about and be able to dial into. We have recently now seen, as you say, a 10, 11-month high now in the crude oil market. That's really created a lot more push in the physical cash market for unleaded gasoline, breaking an average of $4 at the retail pumps around the country, even though the RBOB futures has been moving in an opposite direction, has actually been going lower. I would have thought this and the UAW strike and the potential government shutdown would have maybe dialed back the GDP numbers and made the Fed a little bit more conservative in their update for their September meeting that we just saw today. But instead, there was three scenarios, Jesse. We could either have the Federal Reserve being hawkish, which they have been. They could either be circling to land on the nest, which would mean, kind of a neutral report, or they could actually sit on the nest and say, we're done for the year and we're going to watch and see how the rest of 2023 finishes, or we can go out and kill more game. And I think that's what they did in today's report, is they said, we're still on the hunt. We're still going after more feed and more food. And in that sense, the hawk is very much on the hunt at this stage. And I don't think the market was dialed into this. And this is part of the reason why, is because these gasoline prices, I don't know with these kind of interest rates and this kind of gasoline price, how we're going to deal with this market, because that previous chart we looked at and the fact that the yields in the short term, where everybody feels it the most in the consumption, back to 2006 levels. Think how strong our economy was back in 2006. Doesn't feel and act like a 2006 economy to me.
I'm kind of gathering the legs of my stool here as we have this conversation, Mike, and I hear your answers to these questions. It feels like one leg is the Fed and inflation, the other is energy. I'm going to say maybe this next leg is the general seasonality of harvest. I mean, it's that time of year. Combines start rolling. We get all eyes on what those yield monitors say, and that kind of adds to a little bit of a malaise at times in the row crops and in wheat too, just as the market's kind of focused on, all right, what are we actually going to have out there in the field, Mike?
Absolutely right. That third leg is highly based upon harvest and based upon the weather. And obviously, we've got those numbers coming for the end of the month on the grain stocks, and we'll find out how much on-farm versus commercial stored grain we had as of September 1st, as this harvest came on so early. I'll give you an anecdotal point, Jesse, and this goes back to my visit with my client from Indiana. Very heavy soybean cutting east of the Mississippi River, hardly any corn being done at this point. You get to Decatur, Illinois, and on west, then it starts to really pick up. But Western Corn Belt is really hitting the beans, or hitting the corn very hard. Not as much beans, some dry land, some irrigated in Nebraska, but mostly seeing the beans in the Western Corn Belt. So I put out the recommendation this week, buy bean puts. We went up against major support in the meal market. We went up against major support in the soybean market, both of those monthly charts. And if we can't hold these support levels because of what you're talking about with the harvest, I'm nervous that the beans will lead us down another leg, especially if the wheat doesn't bottom after this Federal Reserve report. So my mindset was get some 30-cent puts in place for January. Hope you're wrong, because if we're wrong, maybe we've got $1 upside, but we could have $1 downside too. That's the kind of move I'm looking at here. And hardly any of the clients in the east of the Mississippi River had any question whatsoever about doing that position, because their bean yields, what they have done, which is more aggressive than the West, has been much better than expected by the large lion's share. And so is the question now shaping up here, can the weather come in and slow harvest down, replace the river water levels, get our transportation back, and can it create some damage in the fields? I hope not, but that's about your best bullish scenario here, in my opinion, because we are in the throes of harvest, and South America said we're pulling back on corn acres and putting more bean acres in. So that's the dynamic we're facing. And I woke up this morning thinking I better start keeping track of 2024 November beans.
Well, I want to talk a little bit more about the lead month soy corn ratio here as well. I think this ties into what we were just talking about. And just looking at this, Mike, I mean, definitely a lot of things to just keep our eyes on here through the harvest. Can you tell us a little bit about this chart?
There's quite a bit of seasonality in here, and past performance is not indicative of future results, but a general trend you can be seen with this lead month ratio, corn divided into soybeans, and then the lines there are two standard deviations. In other words, double the amount it's normal to go higher or lower. And we have gone above 2 standard deviations here recently by going to 3.0. Beans 3 times more expensive than corn on a lead month basis. But seasonally, you notice at the end of the year and the beginning of the next year, we can have a pretty precipitous break to the downside in this ratio. And that's kind of what I'm feeding into, along with some of these other chart technicals. And Jesse, just the sheer fact, and this is as important for the feeder cattle market as it is for the beans, but the sheer fact is the funds, the managed money funds, have the biggest net short in place on their corn futures and options since 2020. Well, they're very net long in the soybeans. So this being the end of the quarter and maybe the end of the fiscal year for some of the funds, the investors, the investor class that work in commodities, I just think you play the seasonals here and take the safe route out of having a floor underneath you in the soybeans, because in part, this chart has now violated that upper standard deviation again.
We're having a conversation today with Mike Zuzolo, president of Global Commodity Analytics. And Mike, I don't want to miss what you said there at the end of one of your answers about paying more attention to 24 beans. I just want to have you expand upon that real quick a little bit more. I mean, it feels like, we get to the throes of harvest and we get busy worrying about harvest in front of us, but I think that's a good reminder to not forget about your overall marketing plan and maybe paying attention to D's 24 corn, November 24 beans, et cetera, Mike.
There is an added element that we have now that we have to face going into 2024 when it comes to agriculture commodities that is pretty much sealed into the concrete at this point. It's not a guess type of mindset anymore from my desk anyway, Jesse, and that is we in the United States, from an ag export mindset, will have a very tough time working with China, working with other big importers that have developed more of an alliance with one another. And we saw fresh statistics again this week that China is taking the vast majority of their imports from Brazil. Yes, that's seasonally typical, but I would also say don't expect them to back off much. That's what's new, and that's what we have to get used to, unfortunately, as we go forward. So if the dollar stays stronger, that's just going to promote more bean acres out of Brazil, and it's going to promote more purchases of China's imports into Brazil, because their buying power as an importing nation of soybeans is going to be better getting it from Brazil than the United States. That's going to mean a lot more for us. And so that's where we face the declining exports in the wheat and the corn. Look at what the market has done to us. They've taken us down, almost 30+% year to date in corn futures, lead month basis. We're only down about 15 in the soybeans. So I know this sounds very bearish, the beans, but I'm thinking it's more of an equilibrium situation, and it's still very profitable to hedge beans right now, whereas in the corn, it's just not profitable at all. And it's easier for me to do bought puts right now in the front end as opposed to cash sales because the basis is 60 under. But at some point, to your point, I've got to get cash sales made in 23, and that's when I'm going to look at 24 as well.
Well, I want to talk as well. This stool that I think we're hypothetically building here in our conversation today, I think maybe the fourth leg of it could be the wheat market here, Mike. And I know you and I talk about the wheat market quite a bit. I want you to, maybe expand upon that thought. Maybe wheat is our fourth leg here today, so to speak. I'm watching world values. I'm watching the tenders. I'm watching the prices here in the U.S., the cheap Russian wheat, et cetera. So give me a picture of what this wheat market looks like currently.
The interesting dynamic here, fundamentally speaking, is we've had APK and Forum cut the Ukrainian harvest of wheat and corn, and now we've had Sovecon, as of today, cut the wheat harvest of the Russian market production down to 91.6 million tons versus 92.1. So they're getting very close to USDA. And we've seen tenders from Egypt and Bulgaria and countries like that get the tenders from Egypt in terms of lowest prices. I'm also hearing anecdotally from French contacts, from Swedish contacts and clients that we are probably at a point in Russia where Russian farmers are having difficulty getting diesel in terms of harvesting and having enough fuel. They're also maybe holding back on sales because their prices are too cheap in their mind. That corresponds with a tighter crop. And so I think we've got the fundamentals in play now where the global wheat crop is going down, but what does the macro and the fund market want to do? And I think this hard red wheat chart is an excellent barometer because we've had the big move up in the European market, and we've extended gains this week in the European wheat and corn, for that matter, because of these fundamentals I'm talking about. This hard red wheat, you notice it tested its major 50-month moving average. That's the orange line. That corresponds with last month's lows. So that $7 hard red wheat level is an absolute piece of solid floorboard that we cannot go through. Otherwise, we could drift all the way down to the solid green support line, which is your long-term trend in hard red wheat established after the 2019-2020 pandemic time period and bigger stocks time period, all the way back down to around $6. And so this is the key chart, I think, going into the end of the month, because we're still drilling wheat in Kansas, but we're not liking it very much. And I still think acreage basis in hard red and soft red are trending down because of weather in hard red and price in soft red, cash price especially.
Well, let's segue over to the cattle trade. I want to give us time there, and both live and feeder cattle, honestly, trying to continue to churn up at these recent highs here. Let's start on the feeder side as we look at a continuation chart. What's your latest thoughts with this feeder cattle trade overall, Mike?
This is a great chart to look at because the highs that we put in for the last 3 months before this current month is right around that 250 plus level. That corresponds really nicely with the 2014 high. So if you don't care anything about the fundamentals and you're just looking for selling profit, with us taking out the last week's lows and feeders of 252.85, we did that today. We were able to recover quickly, and that was good. But you take out this monthly low of around 250 in the feeder cattle, and you go below that level on a closing basis, on a monthly basis, you are putting in a technical top because you're going back below those 3 months of highs and maybe 2 of the 3 months, and you're also challenging the 2014 highs. And I think that is your best gauge right now, as the cash market, while it's still red hot, seems to be flashing some heated signals at this point, especially coming out of the Oklahoma City feeder cattle auction. It seems to me they're getting a lot more picky about what type of cattle they want to buy right now.
Well, segue that over to a monthly live cattle chart. I think a lot of similarities between live and feeder cattle right now, but I know maybe a few differences. So what do you see on the fat cattle side?
Yeah, notice this chart exactly is very close to the old highs from the last 3 months with that 2014 high, but we don't really have any price action that would say we're getting ready to threaten it at this point. So it does lead me to keep believing that the feeder cattle probably more likely to have a topping pattern in it before the fat cattle. This matches up with that feeder corn ratio we've been talking about. And all this goes back to the cattle on feed report that we're going to get this week is what are the placements, especially given the strong drought and these high prices and the low feed costs. You would think placements would be at the top end of the range given those fundamentals. If they're not, maybe we are truly running out of cattle, and that it gives us the chance to extend the gains. And I think that's where these charts come back into play. You take these major support levels out after the cattle on feed report, I think that has some meaning to it.
Something that we need to watch very, very closely, that's for sure. I'll rope the hogs in here as well real quick, Mike. A decent day in hogs on Wednesday, but still different fundamentals than the cattle, obviously. And it feels like this hog market trying to kind of settle in here around this $80 range. What's your thoughts there?
Yeah, I agree. It's got a good base to it, it looks to me, and the cutout's staying very strong. I think we broke above 100 in the morning for the pork cutout. I think that's going to be because of the fact that the packers are bleeding red in the beef side now, and they're going to go after more pork. Makes sense seasonally. So that's an important dynamic here. I think we'll go back to what we've talked about a lot lately, Jess, is the pork side of the equation, export sales, beef and pork, and then the equities markets. Major supporting, to use your analogy, major legs of the stool supporting this move in the cattle market. The other thing I didn't talk about in the cattle market is that we're now at our 16th month higher at this point in a row on a monthly basis. And so we are at a level we've got to feed the bull, and the hogs play a role in that.
Mike, we've covered a lot of ground today. Before we let you go, any final thoughts or anything you want to reiterate today?
I'm hoping that by the time we get to the end of the week that the dollar's back lower, the bond yields are back lower, and we don't take those recent highs out in the bond yields, and the dollar doesn't get back on its buy signal. If it does, and it's going to really put some wheat low potential in jeopardy, and that's where that hard red wheat chart comes into play. So middle of the week, we got the data. Let's see how we look on Friday.
Mike, if folks want to reach out to you and get some advice, I know they could do that very easily. How can they reach you?
Globalcomresearch.com, globalcom with 2 M's, research.com. Sign up for a trial. Take a look at our product services.
Mike, always appreciate it. Thanks for joining me today, and have a great rest of your week. We'll talk to you next week.
You too, Jesse. Thanks for having me.
That's going to do it for Market Talk here today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.